been able to do it in that space. So my name is Jerrel Duffy. I am a lender with National Cooperative Bank. If you can start the next slide, please. And just a little bit of background on the bank itself. We were federally chartered under the Carter administration to support cooperatives nationwide. We've been private ever since Reagan. So we're a unique bank. We're headquartered in Arlington, Virginia, with offices in New York and California. Because of the federal charter, we are a mission-centered bank to support cooperatives. As a result, this is a business that we've developed expertise in since 1978, and it's not something we would ever exit. The bank itself is a cooperative. We are customer-owned, and our customer shareholders are typically cooperatives. As we do well, our customers also do well. We finance cooperative businesses and real estate. And the conversation today will focus exclusively on real estate finance. We finance a lot of preservation deals. These are existing cooperatives that need repairs, that reserves aren't sufficient to finance. We also finance conversions to existing multifamily buildings to cooperatives. As was discussed in the first panel, there's a great policy in DC called TOPA, which is the Tenant Opportunity to Purchase Act. And that gives the renters the right to purchase their own building if it's been sold to a third party. This allows them to convert the apartment to condo or cooperatives, and it's been a very powerful tool in DC. It needs to be financed more and needs more funding, but it's definitely a powerful tool. We have also financed new construction, construction of new cooperatives. And it's my intent today to try to get to all three. I know we're short on time, so I'll try to speed this up as best as I can. As a bank, we offer bank debt, agency debt, CMBS debt, but we don't do HUD. But we could refer you to some excellent HUD lenders who understand cooperatives. Centennial Mortgage is something that comes immediately to mind. Lending is always more of an art than science. No matter what type of loan you're looking at or what you're trying to choose, there's always some level of trade-offs. Bank debt is always going to typically be less restrictive. Could be more expensive. Agency will add more restrictions, agency being Fannie Mae type loans, but they'll typically be cheaper. HUD will even add more restrictions. HUD typically takes a lot longer to close, and they'll have some fees associated with them, but they are cheaper, and it's definitely for a longer term. So navigating the trade-offs can be tricky. With HUD, there typically isn't repricing midway through. But with a 10-year banknote or a Fannie Mae loan, it gives you an opportunity to resize, reprice, add in some additional capital improvement needs that may become apparent later. So one of the benefits of working with us, with NCB, is we've seen different types of transactions all over the country. We have the capability to tailor make a solution for your needs, depending on what it is that you're trying to accomplish. Next slide, please. So the objective here is really to provide a high-level review. I know in the room and online there's a wide disparity of knowledge or what we're trying to accomplish here at the conference. So this may be a little bit more middle of the road. If there's a term that I'm using that you don't know, please don't hesitate to ask. If you have a project that you are looking for financing or have some more specific deal questions, please feel free to reach out to me and we can discuss that more in depth offline. My contact information will be at the end of the presentation, so you'll have that information if you want to reach out directly. So the order of the agenda for this presentation is really just to do a quick overview of cooperatives, go into a little bit more about the financing of existing cooperatives, and then lastly on construction loans for new development. That slide is going to look very familiar. So our former NCB put together a slide deck on sort of the capital stack, and we'll get into that later. But it looks very similar to the slide deck we saw at the first session. Next slide, please. So again, I'll go over this quickly. I think we've talked about this, but some basic tenets of cooperatives. The building is owned by a corporation. The residents of the buildings are owner shareholders of the corporation. The tenant shareholders the tenant shareholder has a right to occupy the unit in the building, and it's governed by a proprietary lease, and that gives tenants leasehold rights. This structure allows tenants to own and operate their real estate at cost. If owned by a third party, there's a profit motive that has to be financed, and that's sort of eliminated in the structure. Next slide, please. The biggest benefit of cooperative ownership is democratic control, enabling tenants to have a say on how their building is run. The cooperative approves who comes into the building, either through sale or subleasing. Limited equity cooperatives can enact resale limitations, some through a hard cap, some through a sort of percentage increase, either tied through inflation or some other mechanism. Next slide, please. So there are two types of mortgages, and we do both here at NCB. We'll be talking about one today. A blanket mortgage is essentially the mortgage on the entire building. The borrower would be the corporation, basically the co-op itself. And then there are shareholder loans, which is secured by the co-op shares in a proprietary lease, and that borrower is the actual shareholder. Next slide. So this goes into some of the specifics in terms of what we're looking for in terms of financing, goes into a little bit of our lending box. We like to see owner occupancy. Reason for that is, if it's investors, if there's more investors, or if there's more subleasing, if more than half of the building is not owner occupied, then we're really talking about a different type of building. We're not really talking about a building that's sort of cooperatively owned, and it has a different risk profile than a cooperative itself. So that's why we have these limitations here. FNMA stands for Fannie Mae. And so sponsor investor units not to exceed 10% in a Fannie transaction. Commercial spaces, we like to limit that not to exceed 20% of the space or by income. The delinquencies, reserves, and insurance, you're going to see a little bit more on that in these slide decks. The box on this is typically, so for delinquencies, if shareholders are late on their payment for co-op fees, and by the way, maintenance charges, carrying charges, co-op fees, they all mean the same thing. It's all sort of interchangeable. So if you hear me say co-op fees or carrying charges, that basically mean maintenance fees. And those are basically just the fees that the tenant shareholder has to pay for the co-op to maintain the building and fund reserves. So for delinquencies, for folks who are late on payment, we like to see that to be under 5% of the annual maintenance charges that are collected by the cooperative. So if it's more than that will have us start asking questions, and to us that's a sign of some potential weakness within the cooperative, and so it starts having us ask questions. 10% of units as well is another measure of how we look at delinquencies. For reserves, sort of cash on hand, cash in the bank, we prefer to see that at least at 10% of the annual maintenance charges collected by the cooperative. If it's less than that, again, we would want to ask questions or find a way to help the cooperative increase reserves through loan proceeds. Next slide, please. So this helps to, again, crystallize some of our discussion between a blanket mortgage and a share loan. A blanket mortgage, again, is the loan that's borrowed by the cooperative entity, the corporation itself, and is secured by the property. And so all the things we were talking about in the previous slide with the delinquencies and the reserves, all of that's going to pertain to what we look for in our lending box for a blanket mortgage. That's not per se how we're looking at it for share loans. Next slide, please. So this slide speaks to why cooperatives might come to the bank for financing. Maybe a TOPA transaction, the Tenant Opportunity to Purchase Act. They may want to refinance their existing mortgage, or their existing mortgage is coming due and they need a new mortgage. So there may be, historically they may have been looking for a cheaper rate. It's not so much what's happening in the market today. But more likely they're looking to finance repairs, capital improvements. Next slide. So this is really going to gear, again, this is towards existing cooperatives. If you're in existing cooperatives, the bylaws for the cooperative would dictate who has the authority to borrow and execute documents on behalf of the cooperative. Financing and getting quotes on capital improvement projects can be a complicated process. So the cooperative should empower an individual or a committee to do this work. After reviewing the options, the board must commit to a course of action. As a means to assess the maintenance and capital CapEx needs, a reserve study is a good place to start. It's recommended that this gets done. A reserve study is when an engineer is engaged by the cooperative to assess the repair needs of the cooperative over the next, say, 10 to 20 years, and how much it will cost to address those needs. And then we'll look at the current reserve balances and how much is being collected over time, and we'll make a suggestion as to whether to increase reserves or maintain them at existing levels. So highly recommended to get that done and to re-engage them periodically. Next slide, please. So typically we'll look at the underlying first mortgage will be the first deed of trust, will be in first position, and they're typically fixed for a period of either 10 to 30 years. There's also lines of credit that we can look at as well. Those are typically in second position, and those are typically adjustable rate type of facilities. Next slide, please. So on this, I wanted to just briefly discuss term versus amortization of a loan. In a typical residential mortgage, it's a 30-year mortgage and it's self-amortizing, meaning that the payments are spread over 30 years and that rate is fixed over 30 years. And this is different from a balloon where the term is, different from the amortization. So, if you have a 30-year, $100,000 mortgage, but after 5 years, the remaining balance is due, and say that's maybe $85,000. That 5-year period is the balloon period, and then you either have to get a new loan to finance the remaining $85,000 that's due, or you can just pay it off through proceeds. Typically, what happens is, after 5 or 10 years, you refinance it. You may even get more proceeds to fix new capital improvement needs that may be self-evident in the property. Next slide. So for us, when we talk about amortization, again, that's the period of time that the payments are spread out over. We can amortize up to 40 years, depending upon the needs of the cooperative. Now, 40-year amortization might not be the best thing for the cooperative. It depends on what your objectives are. Typically, I've seen cooperatives try to self-amortize over 15 years. With the idea of, we have a specific project in mind. We don't want to spread this out to future tenant shareholders. So let's do it with our current existing tenant base, pay it off fully in 10 and 15 years, and have the property, have the cooperative debt free. I've seen that a lot. And I have seen some where, the cooperative just is not in a position to self-amortize. And so you need that extra amortization period. And so some of it is front loaded with the current tenant share base, and then others will be amortized over, over the potential new tenant shareholders that come in later. LTV stands for loan to value. It is the balance of the loan versus the appraised value. And there are typically 2 appraised values that are done on these. One is as a co-op value, and one is as a hypothetical rental value. Now, for a co-op, that just means that really applies to market rate co-ops. It's basically the price that is paid in market for those co-op units, and that generates a value for the entire building. As a hypothetical rental, it's as it sounds. It looks at the building as if it were an apartment building, and it generates a value based off of that. We want to be typically less than 50% on a loan to value basis on that. Next slide. So again, this slide, and I guess we'll make this available to you. Please consider this as a reference deck. The next two slides are going to crystallize some of the things that we talked about in terms of loan to value, in terms of delinquencies, and what we like to look at. Next slide, please. This slide here talks about the reserves, which we discussed, and also what we haven't discussed, the debt service coverage ratio. We'd like to make sure that we're looking at recurring cash flow from the cooperative, which is basically your co-op fees less your expenses, and that has to be equal to or greater than the annual payment for the loan. And if it's less than that, then the co-op will need to increase the maintenance charges in order to be able to service the debt. And that's one of the reasons why you don't see this in a typical multifamily type of structure. If it's a typical multifamily, not a cooperative, the debt service requirement would be much higher than this. The reason why we do this for a cooperative is because the goal of the cooperative is to own the real estate at cost and to take advantage of the of scale, right? And so because it's at cost, we feel comfortable with having a debt service coverage ratio basically on par with the annual debt service. But if it's if there are more if there are less owner occupants, if it's more owned by investors than true cooperators or people who are tenant shareholders, then this wouldn't apply. Next slide, please. This slide deck, I actually have a full presentation on financing renovations. This is basically just a quick summation of different things that we will look for to make sure you have a construction budget and share that with us, with the bank, and know how much you're going to try to pay for it with loans versus reserves. And just know your bylaws, know who has the authority to sign documents on behalf of the cooperative, and make sure you have a plan to finance all major repair items, critical repair items. Now for us, we try to make this as simple as possible for the cooperative. So we will rate lock on day one when it's funded. We would typically advance into a controlled escrow the funds for the renovations. So this has two effects. One, it increases the restricted reserves for the cooperative, and then number two, it gives you a way to know what your interest cost is going to look like over that 10-year term or 15-year term, or however we structure the loan for the cooperative. So that gives you an easier way to budget and plan out your financing or your future budgets. Next slide, please. So for the underwriting process, this is basically from term sheet to close. When we go through this process, we'll first talk with a loan officer like myself. We'll go through the financials and everything that you provide for us, ask you questions about what you're trying to accomplish and your goals. We'll try to uniquely tailor the solution to the cooperative itself. And then we'll provide you with basically a term sheet based off of those discussions. Take that back to the board to get it fully approved, signed with an application to the loan officer. Next slide, please. This is basically just a rundown list, a checklist items of different things we would need for underwriting the loan. And again, this is for an existing deal. Audited financial statements, they could be reviewed or even company prepared depending on the size of the loan. And then obviously your budget and year-to-date financials. I won't go through all of that because you can see that on the slide, but next slide, please. The typical process for this will take about 45 days, 45 to 60 days. Once we get the term sheet back and we start underwriting, from underwriting to close, it'll take about 45 to 60 days. Next slide, please. So once we go through underwriting, then there's a commitment letter so that commitment letter basically summarizes what the loan documents will look like, what the legal documents will look like, and then we'll proceed to closing. You can lock the rate, sort of at this point. So I know that there's a lot of rate sensitive folks out there with what's happening in market with the interest rates and the banking climate right now. And so for us, we can do a 30-day, 60-day lock after it's been approved in underwriting. So while we're working towards getting loan documents prepared and ready, you don't have to worry about where the rate's going to look, where the rate's going to be while we're trying to get the loan documents together. So that gives you the ability to lock the rate in once we get the commitment letter back. Next slide, please. So again, this is another summation of some of the things of key items in our box. We talked about the debt service coverage ratio requirements, the cash reserve requirements, the delinquency requirements, and there's another deck that goes into a little bit more depth, but these are the post-closing, these are the key items that as a bank, we will continue to look for on an annual basis. So we'll continually get some operating statements from you as a cooperative. And we want to make sure that all these items are in line with how we underwrote the deal from the beginning. Next slide. All right, so this is going to get into this is the part of the presentation that looks very similar, but I'm going to tailor this conversation a little bit to basically what does it look like when you're trying to construct a cooperative or do a brand new sort of a ground up build on a cooperative or even a TOPA conversion. What does that look like from construction to permanent? So everything we've talked about so far has been for existing cooperatives, permanent loans. What does it look like when you're converting it from a construction loan to a permanent loan? But before I do that, I guess I can, can we pause here for any questions from the group? I just want to do a quick level set just to, before I go into this part of the presentation, if there are any questions on what was just presented. Okay, I'm not hearing any questions.
I think we got one. Give me 1 second.
Okay.
This is really about qualifying for the loan. Let's say there were delinquencies or sublets or something like that were too high. Would you just say no, or would there be some kind of period where that could be corrected?
No, it wouldn't be a blanket no. It would depend upon the situation. So I've seen situations where the numbers are high because of one or two individuals where their delinquencies are really sort of skewing things in the wrong direction. And there's a legal process in place or a legal process that's being worked out. So that's a different situation. But if it's because 20% of the if it's because 20% of the tenants are late in their payments, that might be a different situation, and we have to get to the bottom of why that is before we can proceed. I think to answer your question, it's a conversation, and depending on how that conversation goes, it may end up being a no, but it's not a straight no right after you trip this. It's more of a conversation and kind of get to the story and the reasons behind it, and if we can get comfortable. Are there any questions in chat? And did that answer your question?
Yes, thank you.
And there are some questions in the chat.
How long did you want to do questions for?
We really don't have time for a couple.
Okay, let me do one or two questions, and then I want to get into this capital stack conversation.
Okay. Then let's start out with, we got a question from Sam. How does this fit with earlier discussion of being able to finance 98% of the cost of the co-op?
Yep, and I'm going to get into that into the next slide deck. But 98% is really a HUD product, and again, it's kind of there are risk and benefits to HUD. 98% is a really good level of, loan to value, but it's a 30-year product. And while it's cheaper, it's also longer to close. So it could take an 18-month process to just to get to closing. There are typically a lot of fees associated with that. And the complexities of a HUD deal in terms of getting it to close and the things that you have to do throughout the life of it is much different than a bank transaction. The bank transaction is going to be a little less restrictive, but it's not going to be as high as in proceeds as you can get with a HUD transaction. And some of that too is deal by deal specific. So on a 98% of value, it may be not the value that's restrictive, but the debt service that's restrictive. So if you're looking at a limited equity cooperative structure that may or may not have a HAP contract on it, and I'll get into that a little bit later. It could end up being that what's the more restrictive is not the percentage of proceeds relative to value, but is the level of proceeds relative to debt service. In which case, it may not make much of a difference between a HUD transaction or a bank transaction in terms of proceeds. And then you're really looking about the difference between, what type of, how fast do you need to close? Can we live with these requirements through HUD, or would we rather have lesser requirements with a bank? So that's really where the art versus the science comes in. Good question, and I'll talk a little bit more on that in capital stacks.
Appreciate that, Jerrel. And just wanted to say, if you could, after your presentation, maybe come in and answer some of these other questions in the chat. Appreciate everybody for asking questions and staying engaged.
All right, perfect. So let's go to the next deck. Next slide. So when I say capital stack, what do I mean? Capital stack is basically just a term to say this is how a project is financed. It's typically a combination of debt and a combination of debt and equity. Next slide. So this one talks about, sorry about this. So the types of equity is really, from either cash from owner, cash from investors, grant dollars. If you're an existing cooperative, this could mean reserves, right? As a new cooperative, you're looking to finance this. Grant dollars would be a potential source of revenue for equity. For debt, we're looking at bank loans. We're looking at potential HUD debt on this. You can look at agency. You can look at soft. Now on HUD, I have the 213 and the 221D4. There are also other products that allow you to basically refinance an existing loan. So say if you didn't want to wait for one of the downsides to HUD is that it takes a long time to close. But if you want a quicker transaction, you could do a loan from a bank, then have that refinanced through HUD. Again, the fees on that is going to be you're going to pay for the fees. But if it's something if it's a timing issue and you really like HUD as your long-term debt provider, there's a way to do that, and it has to make sense for the size and scope of the transaction. It's not going to make sense for every deal, but for a universe of deals, that may make sense. Soft debt is essentially debt that is not must pay. So you'll see housing itself for this is really a limited equity cooperative discussion at this point. So if you're looking to do say it's a TOPA transaction, where you're looking to convert an existing multifamily, keep it affordable in a co-op type structure. In order to make the end loan work, you're going to have a little bit more friendly equity in your capital stack. So that may mean grant dollars that doesn't have to be repaid. That may mean soft debt, which again also doesn't have to be repaid. That's repaid if you have excess cash flow available to repay the debt, but it's not what's called must pay. A bank is must pay. If you don't pay it, then you're in default. With the soft debt, if you don't pay it, it can accumulate, but you're not really in a default situation where the soft debt provider will foreclose on the property and take the property and do all and go through that process. Soft debt is usually provided by housing authorities and things in agencies like that. Next slide. So on the construction debt, typically, if it's a market rate deal and you're a developer, we're looking for some type of sponsor to guarantee, either principal and payment guarantees or completion guarantees. This is a sort of a TOPA conversion, and you have the co-op already in place. You have tenant shareholders already in. It's cash flowing. It has a certain amount of cash flow. That may not require a sponsor at that point because the building can support it, can support the must pay debt. But usually you'll see, especially if it's in if it's an affordable deal, in other words, a limited equity deal, there's usually some component of housing authority money in there, whether that's either as a form of a grant or a soft debt. In a typical construction, like you say, if it's a ground up construction deal, there's going to be some level of pre-solds. There's going to be a construction vehicle that operates kind of more like a line of credit than a permanent term loan, like the loans we were discussing before. That debt gets paid down as you start selling more co-op units. So as people buy in, say it's a market rate deal and you're selling these things at $280,000 or $300,000, not necessarily a sort of an affordable deal, but market rate. Those proceeds from the sale can be used to pay down the construction debt, and so that's typically how that will work. Usually there will be some level of blanket loan or mortgage at the end that will be transferred over to the cooperative that will be must pay debt over time. So next slide, please. So this goes into the capital stacks, and I told you this is going to look very familiar. And while the color schemes might be different, don't let it fool you. It's the same size. So single family, typical, 80% debt, 20% equity. Next slide, please. And a condo model, what you'll see is you have a building where you have debt on the bottom, which is the representative of the orange. The blues represent the equity. And in this case, each individual unit has its own debt and equity. Next slide, please. Well, this is the cooperative model. So let's say at the end of the construction deal, say it costs, you had a $10 million construction loan. You sold you sold the shares in the cooperative to different tenant shareholders, and at the end of all that, at the end of the sales and at the end of construction completion, and you're now in ownership and it's now cooperative, there may be $3 million left. So that $3 million is the blanket loan, is the mortgage that remains owned by the cooperative. And then the share debt is essentially the debt that, and I talked about this briefly, and again, this isn't going to be a shareholder loan discussion, but each shareholder, we do provide this service. They can come to a bank like us and ask for financing for their unit. And so if it's a $300,000 share price, maybe we can finance $100,000, $200,000 of that. And so you'll have, a piece of equity, a piece that's the share debt, and then the piece that is for the cooperative. And that's what this represents. Next slide, please. And this one here is basically showing no share debt. So you started with a $10 million construction loan. You're able to sell all the share loans and all the units. And at the end of the day, it paid down the entire construction loan, and all that's left are the share debt, and then the equity per unit. Next slide. And this is the HUD financing, which you saw before. So in this case, you're using the 213. So you're using a HUD debt to basically do the entire build out. HUD remains as your sole source of debt on the loan on the building, and then that's extended for an additional 30 years. So the entire project is essentially financed through debt. Next slide. And this one here refers to, again, this is the sort of the blanket loan at 30%. Then you have some untapped equity and sort of restricted equity, which is more of a limited equity model. Next deck. And this here shows basically your mixed income model. And I know I only have a few minutes, but I just want to touch a little bit more about what can, in a limited equity cooperative, what that might look like. So in a limited equity, say you have, same situation, $10 million project, you're selling these things at say $300,000 a unit or whatever. Then you may have some units that are limited equity. And so you're not selling them for 300,000 units per unit. You may be selling them for 25,000 or 10,000. And the way the math can work on that is if you have a partial HAP contract on the property. So if you have a project-based voucher that allows you to get close to market rent on the property, on the units, that will allow the sort of the operating math to work, where you're getting a combination of market rate coming in to subsidize basically some of the limited equity units. And collectively, you're still getting the cash flow that you need in order to support and operate the building. We finance a ton of those, either full project-based voucher, limited equity cooperatives, or partial project-based voucher limited equity cooperatives, where it's sort of more of a mixed income type of project. So that's one of the ways that you can make the math work on these types of deals. Next slide, please. So larger Q&A. Next slide. This is my contact information. So feel free to, if there are any project-based or any deal-specific questions, feel free to reach out to me, and I'll take any questions now that we have time to get to. And if I can't get to your question, please feel free to reach out.